You know the cliche, don't tell anyone in equities. The fixed income guys are smarter. We all know that. Lecture the equity market now. What is your market telling stocks?
Yes, I won't comment on the equity guys, but the bond market does usually know. And what the bond market is saying is just what Lisa said, that the inflation problem is what is transitory, right? That there is no long-term impact, that there is no long-term fear, and that the Fed won't really get off the ground. I think you're seeing a little bit of that in some of the relative moves in the NASDAQ in the last few days, in that we're taking away some accommodation. And that's really all that's happening. We're still near the highs. There's not a lot of fear in risk assets. In fact, I'd argue that the Fed being unanimous in its decision, wanting to raise rates slowly, is actually long-term okay for risk assets, and long-term rates being low, the same.
Explain that, Brian. Why does it matter that they were unanimous?
Well, I think we've seen some discomfort in with the hawks anyway, with the policy, right? We have inflation, we have fairly stable markets, and yet we're buying billions of dollars of treasuries and mortgages a month. And I think by taking that away and admitting that we don't have to raise rates more than 3 times in 22 and 3 times in 23, at no point do even the hawks really have the Fed funds rate getting above neutral. Now the market disagrees, right? The market thinks neutral is closer to 1.5, and the Fed thinks closer to 2.5. But the unanimity tells you that they're not really trying to aggressively tighten. They just cannot be in a position where they're pumping liquidity at a time where inflation is as uncertain as it is and trending higher.
And so, Brian, we stick with a negative real yield and we try and search for more yield in corporate world and high yield world?
Our clients have really spoken with their feet this year. Yes, looking for income in places like bank loans, floating rate, where there isn't as much duration, in the corporate world if they can find it. When the front end sells off like it has, you see how much cash is in the Fed's repo facility. So move out the yield curve and capture a 70 basis point 2-year note or a 1% corporate rate in the front end. It's not super exciting, and our equity friends will be happy because it keeps money flowing there. But yes, look for yield and don't expect rates to go wildly higher.
Brian, Tom Keene raised this conversation saying that bond traders are smarter than stock traders, that the bond guys are the smartest guys in the room. Are they this time? Or is the bond market not as predictive, not as much of a signal because of the distortion that, frankly, Fed Chair Jay Powell himself pointed to in disregarding the long end?
Listen, there are definitely technical factors that keep longer rates down, and it's been a risk for a while since QE has been such a prevalent policy. But the truth is, with the exception of the last couple of months here where inflation's really spiked, which the market really did not predict, the bond market anyway, it's been pretty correct, right? It's been hard to keep long-term growth rates in developed worlds high. We'll see if inflation stays sticky. So there's a risk, but as the Fed pares back QE, we'll find out.